News that Intel's foundry business just received a prepayment from a quote-unquote whale customer is sending the stock up over 3% today as the general market is down. So this is obviously a great piece of news for the company, and what I'll be doing today is I'll go over some of the trends I'm seeing within the semiconductor space and tell you how that's going to positively affect Intel. And then I'll also, at the end of the video, I will give a price prediction based on technical analysis. So with that being said, let's dive right in. So last month, Intel's CEO, Pat Gelsinger, disclosed that the company had received a prepayment for its foundry business to use upcoming technology node, which is scheduled to go into production in the second half of next year. The customer's prepayment is from a potential whale. What that means is just a huge buyer. So the analyst also added that Intel is looking to secure one more whale, but did not give any update on which companies Intel is working with. We have no clue who this is. For all we know, it's Tesla or another big company like that. We just don't really know. So we'll obviously find out more in the future. And then earlier this year, Intel's CFO said he expects the company to announce a major foundry customer later this year as the semiconductor giant attempts to compete with the likes of Taiwan Semiconductor, Global Foundries, and Samsung in the chip manufacturing for other companies. So Intel spokesman also said at Citi's technology conference on Wednesday that they should see real revenue from their foundry business in either 2026 or 2027. And while gross margins will be below the company's historical range, they will still provide attractive operation margins. So for those that don't know, Intel is making massive investments in foundry businesses in the US and other areas. They have one coming up in Arizona, and that really should take some stress off of the chip supply chain, because right now the bulk of the chips that the US uses comes from outside of the US. And the US has kind of been cracking down on Chinese chip production as the US is weighing additional restrictions on AI chip exports to China amid concerns over the use of advanced semiconductors for military modernization. So basically, they don't want to provide China with chips because they could be using it for military purposes. So this kind of domestication of the semiconductor space will bode really well for a company like Intel, which is making massive investments in the U.S., with their new foundry business, like I said, coming in Arizona. And the latest move is part of the U.S. broader strategy to limit China's progress in AI, particularly in the military sphere. So like I said, not going to beat it to death, but there is a serious trend going on right now in the semiconductor space, and it's just simply domestication of semiconductor supply chains. And that will bode very well for a company like Intel making massive investments. So first off, I'll read out this note here from Bodon Kerr. I'm not even going to try with that last name. I wouldn't be able to pronounce it. But so from this article from Seeking Alpha, what's more interesting is that as Western governments are racing to secure supply chains for chips, Intel is more than likely to start receiving additional government funding to expand its business this year. The company has already submitted its application to the U.S. Department of Commerce to receive funding under the U.S. CHIPS Act so that it can accelerate the construction of its fab in Arizona, as I had said. At the same time, it seems that Intel is engaged in the lobbying campaign to get access to most of the funding under the CHIPS Act, as its CEO, Pat Gelsinger, said that he believes his company should get most of the money under the program just because they're the ones making those massive investments. And then Germany has also agreed to subsidize the company's expansion on the European continent, while the recent approval of the EU-wide CHIPS Act could help Intel accelerate the expansion of its business. So, it's awesome to see that they're trying to expand their business, but they're actually doing it with the help of the U.S. government, right? So we had that CHIPS Act passed, and that's only going to provide funding and further assistance to Intel, right? So the opportunity within the market is there, and the government is basically kind of nudging Intel towards this crucial spot. So that's definitely a good thing for Intel. And then with that being said, I'll cover a couple more notes here. So Intel reported decent earnings results for Q2 and a good enough guidance for Q3 last month. The stabilization of the PC market and the growth of the generative AI industry could indicate that the worst for Intel is finally behind it. After reporting decent earnings for Q2 and expecting decent growth in Q3, Intel appears to have momentum on its side, which could help its shares to appreciate further from the current levels. At the same time, the potential end of the downturn in the PC market, along with the expansion of total addressable market thanks to the growth of the generative AI industry and the higher demand for chips in the future, could indicate that the worst for Intel is finally behind it. So it seems like the worst for Intel is definitely behind, this company. So with that being said, I'll jump into some of the financials of this company that you should be aware of. So over the next 12 months, we're projected to have a PE of 58 times, which is well above Intel's past 5 years of their average 5-year PE of 18 times. So that definitely signals that the company is pretty expensive relative to its own history. And then we can see here that price to book ratio is at 1.5, which is actually well below the sector median at 4.0, which we do love to see. And we're actually also below Intel's 5-year average of 2.3. So net, Intel is cheap on a price to book ratio basis, but is expensive when you take a look at that price to earnings, which is obviously more important. And then let's take a look at some growth numbers for the company. So we can see here that revenue had dropped 26% over the past 12 months, and revenue for the next 12 months is projected to drop another 7%. So although revenue growth isn't turning positive, it is good to see that we're at least seeing declines in growth somewhat slow. So that is at least good to see. Obviously, you'd like to see that number obviously be positive, but it is good to see that the trend is at least pointing in the right direction. So with that being said, let's take a look at some of the profitability numbers for this company. So we can see here that their gross profit margin is 38%. For those that don't know, gross profit is basically just cost of goods sold minus revenue. It tells you what a company makes for what it sells. So 38% is a pretty good number here. It is unfortunately below the sector median though, and is below Intel's 5-year average. So shouldn't really say it's a good number. Kind of misspoke there, but really it's not the worst number in the world, but it is worth noting that gross profit margin is below the sector median and is below Intel's 5-year average. So profitability, growth, valuation, they all look kind of worse than Intel's sector and Intel's 5-year average. And then net income margin, same thing. We have a net income margin almost minus 2%, which is below the sector median and below the company's own 5-year average. So once again, not a good number. And then we have about $2 in cash per share, which is roughly about 5% of the market cap in cash per share. And then with that being said, let's take a look at the balance sheet for Intel. So the company has $24 billion in cash and $49 billion in debt, meaning that the company has $23 billion more debt than cash, which obviously isn't a good thing. And then when we take a look at Texas Instruments, AMD, Qualcomm, and Micron, you can see that Intel actually has more debt relative to its cash than any of these companies. So in terms of a balance sheet, honestly, Intel's balance sheet does look pretty poor relative to the peers. But with that being said, let's keep it moving on to profitability here. So we can see here that profitability is at 38% for gross profit margin, and that is below all peers besides Micron. So once again, pretty poor number there for profitability metrics. Same thing with net income margin. We're the third worst company out of all of our peers here. And then for growth, I'll do Intel a favor and I'll look at the 5-year compound annual growth rate. We can see that that is below all of our peers besides Micron. So, once again, these financials do look pretty poor. And then let's take a look at the PE. So the non-GAAP PE is 58 times, and that is more expensive than AMD, Qualcomm, but actually not as bad as Micron. So, second worst company here in terms of valuation. So you add it all up, these financials do look pretty poor compared to the peers. But, as I said, just to kind of caveat that, given the company's making so many massive investments, and I think they're making investments at the right time, I do kind of see why some investors are looking past these numbers here. And with that being said, let's take a look at the chart here and see if we can't give a logical price prediction. So first off, I think shares likely move higher over the coming weeks, and that is because we just broke a major resistance level at $37, which is where shares had topped out in June. It's also where shares had topped out in July. So, given we just moved above this resistance level at $37, I do think we could get a larger move higher over the coming weeks. Don't be shocked if we get somewhat of a pullback over the next day or so, though, as the stock is oversold according to RSI. Last time we were oversold was the 28th of July and in mid-June, where shares had pulled back both instances. So the stock has a history of pulling back from oversold levels, so that leads me to believe we could see somewhat of a short-term pullback for this stock over the coming weeks. Over the coming days. I think longer-term, weeks to months out, the stock is going to be higher. How high does it go? Well, the next real major level of resistance is at about $43. So you could say there would be a pretty logical move. So kind of my price prediction here is that we get a move from 37 up to 44 over the coming months. And this is just where shares had bottomed in February and March of 2022. So past resistance becomes new, past support becomes new resistance. So I think this $44 level acts as resistance for the stock when we come off to test it. And then with that being said, let's take a look at the best months for the stock in its history and the worst months based on purely trading data. So the company's been trading for 50 years, and in that 50-year history, in September, shares decline 1.3%. September is actually the worst month for the stock in its history. So, given we're oversold, worst month in the stock's history, don't be shocked if we get somewhat of a pullback for this stock in the short term. Like I said, I still think the stock heads higher over the coming weeks. So, with all that being said, I think Intel is making investments at the right time in the right sector. So, I really do think these investments will bode very well for Intel over the coming years for this stock. So I'm bullish Intel. I like this stock. With that being said, I hope you enjoyed the video. I will end it there. If you got some value from this video, please leave a like. We post company breakdowns and important market moving news on this channel on a daily basis, so make sure you are subscribed. If you would like to receive my daily portfolio moves, my exits, my entries, and see how me and my team of analysts are trading the markets, join the Discord through the link in the description below to get our free 7-day trial. Also, if you would like to join our free daily newsletter, sign up to our Substack, which is linked below as well. With that being said, good luck everyone, happy trading, happy investing.